earlier on, today's topic is just going to touch a little bit on some of the factors that can affect FKLI performance in terms of prices. But before that, I'm just going to give you a very brief overview on how the world economy plays out, because I guess this is important. Whatever economy situation in the world will have repercussion, especially to the Malaysia market. I'm just going to touch a little bit on price seasonality. If you are trading the market, it's important for us to look at seasonality. If you are trading the commodity space like crude palm oil futures, it's equally very important for you to look at seasonality. I believe, historically speaking, historical tend to repeat itself. There'll be certain periods, certain time where prices would tend to be strong and prices tend to be weak. So later on, towards the second part of this session, I'm going to touch a little bit on seasonality, as well as I'm just going to cover 5 simple trading steps. If you are new to the market, perhaps you can use it. If you are already currently trading the market, it's good for you to explore further, or rather explore varieties of trading methodology that's outside. So let's just start with an overview of how the global situation is. Just this year is indeed a very phenomenal. We are indeed in a pandemic crisis. We're in a health crisis. So if you just look at the economy early part of this year, majority of the developed economies are in major lockdowns, and therefore growth is not going to be very good. But towards the second half, as the first waves are being cleared, before we head on to the second and third wave crisis, I think economies sort of take a breather and start to recover. And if you are in the stock market, if you especially look at US indices, it almost make a V-shaped recovery. Now, if you just look at latest IMF projection, I think for this year 2020 is almost as good as given. We're probably going to see contraction throughout the whole, almost every country in the world except China. And this year, I think world GDP is expected to contract by 4%, which is, I think, in 100 years history, I've not seen that. It's even worse than the global financial crisis. It's almost comparison to a Great Recession in the 1930s. So I think it draws a lot of comparison to history. And indeed, we are in very tumultuous and very difficult and yet challenging times. However, I think IMF is giving a very robust projections next year. I think everyone is looking forward for 2021. Everybody is expecting recovery to be on phase in 2021. But let's keep our finger crossed. Hopefully, we are able to see better numbers for next year onwards. So if you just look at the breakdown, I think US, some of the major developed economies, especially the Europe region, Japan, everyone is actually reporting contraction, including our own Malaysia itself. We are also reporting a contraction year on year. So I think it's no surprise that this year we're going to suffer a record contraction for most of the major economies. But I think moving forward to next year, a lot of countries around the world is expecting a V-shaped recovery in major of the key economic sectors. Now, if you just look at the breakdown even further, you can clearly see that the manufacturing numbers, the retail sale numbers, even the global trade numbers are actually improving, despite those numbers are below the pre-COVID levels, but they are inching towards the pre-COVID levels. And given time, probably we could reach pre-COVID levels as early as in the next 6 to 8 months' time. But obviously, these numbers are worth to watch out for because, like I say, I think if you just look at some of the numbers, those numbers, even though are robust, but they are still being stopped by recent lockdowns that's actually happened across Europe. So it's important for us to watch in coming weeks or months how this lockdown is going to potentially play out in terms of their respective economic numbers. But given the onset you are seeing now, those numbers are looking good. It's just only a matter of time whether are those numbers sustainable and whether recovery are solid. Now, despite we are in a global pandemic crisis, I think it creates and it stimulates a response throughout the world globally. Especially you can see advanced economies like US, Europe, UK, they have done massive monetary policy expansion as part of the policy package. And how they do that is by lowering interest rates down to the floor level. if you just look at advanced economies, you just look at US itself, it's almost close at 0 to 0.25 interest rates level. And obviously Malaysia itself, we have just cut this year alone, we've cut 125 basis point. That's pretty substantial. It's also comparable back to GFC crisis. So this highlights the importance and the steps that's taken by central banks around the world to shore up their finances. Now, the side effect of this policy is that with so much liquidity that's being pumped into the system, given the low interest rate environment, a lot of this liquidity has actually went into asset classes. And one of the major asset classes that actually benefited from this policy expansion is mainly the stocks market. So if you just look at Dow Jones, you look at Nasdaq, you look at S&P 500, all three of these indices has actually made a V-shaped recovery, and in fact has actually factored in most of the positive news. And I think as a result of so much liquidity in the system, there's a bit of overflow into these markets. And obviously, if you look at central bank balance sheets, what is shocking is that between a span of just 8 months, the world central banks alone, especially the G4 countries, has actually increased their central bank balance sheet by almost 12 trillion US dollars, and that's a substantial amount. So with so much liquidity in the market, they're bound to go somewhere. So obviously, we are seeing valuations out of place, especially you look at technology stocks, those valuations are way off the roof. And I think these are all pretty normal because there's so much liquidity in the system, it's have to go somewhere. Now, just diving down deep into the economic numbers. Obviously, you have seen recovery towards the early part of second half this year, especially in US and Europe regions. But surprisingly, I think in the last 4 or 5 weeks, Europe region has actually went down south. A lot of their major economies, especially Germany and France, have started to re-engage the lockdown in certain cities. So you can clearly see on this chart on the left, you can see open tables we represent bookings in restaurants actually went down. And that shows that people are actually back into lockdown mode. So obviously, recovery in economy always emphasize on mobility. So if people can't commute around, they can't move around, the economy there's no traction for the economy to move ahead. So with stalling, with cities under lockdown, especially in Europe region and US, certain parts cases are getting higher. There's also there's even pressure for mayors, those cities to try to reimpose the lockdown into their respective states. So the risk of a second lockdown measures are putting a lot of pressure in terms of economic numbers. As long as these booking numbers keep continuing to dwindle, that shows mobility are being constrained. And I think therefore, we should see economic recovery starts to slow down in months to come. It's very crucial to watch how next couple of months is going to play out. And obviously, we have the vaccine booster news, and hopefully that will give us a bit of a positive limelight in spite of the gloom that we're seeing. Besides the booking that is slowly coming down, we are also seeing higher rates of bankruptcy among companies in US. In fact, 2020 alone, those levels are in fact higher than the great financial crisis in 2009. So those numbers are also painting a very bearish picture in the underlying economy undertone. But however, if you look at stock markets, again, stock markets is always a leading indicator. It's always painting a 6 months forward picture. So it's painting a recovery that is expected to come in the coming months. Okay, now, despite weak fundamentals, economic fundamentals, another area of concern which I like to highlight and bring the audience attention is obviously the concern of inflation. Right now, you can clearly see inflation is pretty much controlled, but what sets the tone is that in the past 2 meetings, the Fed chairman Jerome Powell has mentioned that US might have the chance and opportunity to be more flexible with their inflation targeting. That means, most central banks, most major central banks in advanced economy like US, Europe, and to a certain extent the UK central bank, they do practice a 2% inflation targeting level. Now, when they are mentioning that they are flexible in approaching those levels, is trying to indicate that they don't mind inflation to be going a bit higher. Now, sign of inflation in the dwindling economy as what we're seeing right now is naturally good. But if we cannot control or we cannot contain the inflation well enough, we can run a risk of hyperinflation. And obviously, this is not going to be a risk in the near term, but it's something to watch out in the midterm when we are obviously going to a recovery mode, when economy starts to recover, when economy activity starts to recover, inflation will definitely be a concern going forward. So it's always a question, since Federal Reserve have been printing so much money, when will they roll back? So I think this is a question that if you are investors or you're in trading, do keep this mental frame in your as a midterm risk that you should assess going forward. Obviously, commodity prices has been on the rise. If you are trading the CPO market, you probably have known, or we have seen prices above 3,000 right now. And besides that, if you look at grains market, the corn, the wheat, the soybean, those prices are also going higher. So this tries to indicate that commodity prices are actually on the rise, with an exception of crude oil. And crude oil is actually a sentiment of the global economy. So once global economy starts to pick up, we probably could see higher crude oil prices. So do watch out on the commodity space, because higher commodity prices will actually try to raise the overall inflation level in most countries. Now, just 2 days ago, we just heard the good news from Moderna, and the week before we heard the good news from Pfizer. So vaccine developments has always been on the go, and obviously with the two significant major results, with both vaccine producers actually indicated a very fantastic results with a efficacy rate of higher than 90%. Now, market take that with a good stride. In fact, look at Dow Jones, it went up. It rallied almost 1,000 points once the announcement of the result of the vaccine test. And obviously, I think the whole world is paying attention on the vaccine development. So this COVID crisis will be here to stay. Vaccine is the only answer. And obviously, if you just look at the implementation, what market is forecasting is that probably by early next year, we should see vaccine to be massively developed and implemented in some of the major economies. Now, what I want to bring your attention is that if you notice how the market have reacted towards the vaccine news, you probably have indicated, or you probably have reflected that a lot of the funds have actually made a rotational or thematic switch. So the main theme is no longer on healthcare, it's no longer on tech, is still quite relevant in probably in the near or midterm picture. But a lot of funds has actually switched from stay-in-home teams to probably the brick and mortar teams, which is your retail space, your tourism space, or even your industrial space. So those sectors are actually trying to gain popularity. And in fact, you look at Dow Jones performance, these are the companies that's actually gained quite a lot substantially upon the announcement of Pfizer and Moderna results. So going forward, it's very crucial to watch how the vaccine development is going to play out. So currently, we have so many vaccine developers on the phase 3 mode. Hopefully their results are positive, and hopefully we have more vaccine developments in the pipeline. So if you want to keep track on some of the latest vaccine development, just head on to New York Times. I think they have a very good coverage on the vaccine trackers around the world. So it just gives you an indication on how many vaccines are ready and to be on the pipeline and ready to be pushed out to the masses. Now, I want to highlight again an important shift, especially when we are trading, or in fact when you are looking into investment teams. We are indeed going through a paradigm shift as we speak. Obviously, if you just look at the US election, the much concluded US election, we have seen the tension rising between China and US will continue to stay. And in fact, they are looking into President-elect Joe Biden's policy on China. But I just want to highlight here is that if you just look at the thematic that's going to go forth in the next coming 5 years or so, it's going to be the technological space. And I think China being very nascent in the early stage, but they have grown leaps and bounds. China is potentially a major player in this space. And I think what I want to emphasize here is that how we see the US and China trade war is going to play out. will have to depend on how China is going to be a major player in the technological space, especially in the semiconductor space. And obviously, semiconductor is a very precious space as the world moving into 5G, into AI, into machine learning, into the next paradigm shift. And obviously, the demand for semicon is going to be increasing. So whoever control that space will definitely command political pressure across many other countries. So this is a crucial space to watch out, and I think we are indeed in a paradigm shift. So be aware and cautious on whenever you make your investment teams or even your trading decisions. So with that macro picture in mind, and with that global economy overview, let's head on to what matter most to us, especially when you trade the FKLI market. Now, again, I think this list of factors that affect FKLI performance are not exhaustive. There are going to be a lot of other factors that's going to be affecting FKLI performance in general. But I just want to cover some of the critical points that factors that can affect FKLI performance. So obviously, the first one is going to be external economic environment, which I just highlighted in the earlier part. It's going to be like U.S. economy, or it's going to be the U.S.-China trade war. Those were definitely going to have impact on Malaysia. And obviously, we have internal economy, which is going to be like, what are your employment figures? How about your budget 2021 plan? Will there be more stimulus measures? So those are your internal economic factors which will affect FKLI performance. And obviously, KLCI as an index, they comprises of different component stocks, and those component stocks do have certain amount of weightage on the KLCI overall performance. So what affects those stocks could affect the index as a whole. So we're going to later on describe on how these dynamics are going to play out. And being Malaysia, we are a crude oil exporter. Crude oil performance, crude oil prices going to have a heavy weighting on the overall FKLI performance. Malaysia ringgit is one of another factor. And last but not least, government policies and measures. So let's just start looking at FKLI relative to the world performance. Obviously, March this year was the lowest point of our index for this year's performance. Our index went as low as 1,002. Dow Jones, I think, went even as low as 18,000. But then after that, we saw a massive recovery. So what we're trying to highlight here is that, despite government pumping so much liquidity in the system, there's no reason the market should not be rallying. But I just want to point your attention to the FKLI in relative to Dow Jones, just early part of August, where you can see there's a clearly divergence between the Dow Jones performance and the FKLI performance. But of course, off late, we saw Dow Jones has break the all-time high, and that also prompted the FKLI to actually rally forward. But it's crucial to watch whether FKLI could try to climb back up to probably try to close the gap between the Dow Jones and the FKLI market. Now, if you look at internal economics, I think once Klang Valley right now is on CMCO, so mobility is going to be in restraint. There's going to be lesser mobility, and therefore people going to go out lesser. Demand is going to fall. Even shopping centers are recording a lower footfall. So all this will have an impact in terms of the economy in general, because it's going to affect businesses, it's going to affect stocks performance, and in turn, it's going to affect overall economy. And despite we being in CMCO states for majority of states in Malaysia, other economic fundamentals are also pointing pretty much a bearish undertone in the underlying KLCI index, which is mainly you look at it, look at Malaysia economy, we hit an all-time high in terms of unemployment numbers back in early part of this year. But obviously those numbers has actually recovered slightly, but those numbers are still high. In fact, if you compare back into the GFC levels, we are still much higher than that. And interest rate again is another concern, because there's not much room for policy maneuvering. And in fact, I think rates are going to stay at this point, this kind of level for pretty much a long time, until we see economy starts to gradually recover. Now, GDP is a main factor, And I think this year, as I mentioned in the beginning of my slides, I think this year is almost as good as given. Malaysia alone, I think we recorded the biggest contraction in history in the second quarter of this year. I think it's negative 17%. And I think recently in Bank Negara's report, we're probably going to be getting negative 4 to 5% in terms of GDP growth. So there won't be any growth this year. In fact, we are contracting. But next year, we are looking at about 6% growth. That's based on Bank Negara's numbers. Those numbers are very robust. That's indicate that we are expecting economy to gradually recover, and in fact, it's going to recover to pre-COVID levels. So I think that's trying to tell you that the economy in general is going to head on to a better footing next year. Again, I think I like to highlight we are in the CMCO period right now, so it's in a way restricting mobility. So they're bound to be a little bit of constraint in terms of the economic numbers, and that will definitely affect the economy in general. And obviously, I think this year, if you just look at government's book and balances, I think this year, probably we're gonna see an increase in deficit, which is pretty predictable because we are in a pandemic crisis. The government has to respond. The government has to embark on stimulus measures, which will put a lot of pressure on their debts. But this is given because we have to safeguard the welfare of the public, and it's a way for the economy to really step foot on a better ground next year. So I think in terms of deficit, it's going to get wider. But obviously, I think in terms of the recent budget that we've seen, it's going to be a bigger budget, and hopefully the multiplier effect will start to kick in next year, and that will probably in a way reduce the overall deficit that is going to see next year. Now, just comparing FKLI with other major indices, major index between the KLCI benchmark. So obviously we have the KLCI, the top 30 counters, and we have your mid caps and we have your small caps. So if you just look at it, I think the recovery segment that we're seeing, the best recovery segment that we're seeing is in the small cap sectors, followed by the mid cap, and obviously we are seeing only in recent weeks, or in fact days, that we are seeing a huge recovery in terms of the top 30 counters in KLCI. Now, I think in a way to assess FKLI performance, price performance, it's good for us to assess the fundamental stocks that constitute in the index itself. So KLCI constitute 30 different stocks across different industries, and therefore I think each stocks will have different type of weightage. And whichever stocks has a heavy weightage, that stocks will have a lot, will pretty much determine where the index is going to go. So if you look at it, I think KLCI in general as an index is very heavy weighted on financial services. You can look at Public Bank itself, Maybank, and even CIMB. These three financial counters is already including probably about 26 to 27% of the index price movement, so which is quite substantial. Then obviously follow on by even like growth, which is under the healthcare segment, is also quite substantial. Just Harta Lega and Top Growth itself, they're looking at about 10% of the index. So understanding the constituents of the stocks will help you to understand where the likelihood of the KLCI index performance is going to go. So just comparing the different sub-segments of the index. So obviously technology is always a team to go. Early part of this year when everyone was in the lockdown, everyone was going for a thematic play, technology was the one. Whether you are working from home, you definitely benefit from, you're definitely using technology as part of it. Even webinar that's conducted today is also based on the technology platform. So technology is always the driver in thematics, especially when we are in a COVID era crisis. Plantation surprisingly has been a very good performer this year. I think average price this year is probably going to be 2008, 2009, which is going to be 3 or 4 years high in terms of CPO prices. So plantation is another sector that's actually doing very well. Followed on by financial services, property and construction. So these three parts, the financial services, property and construction, I would say the laggards of the indices. Of late, financial services has actually recovered. We have seen massive rally in some of the banks. Property and constructions are also starting to gain a bit of gain a bit of advantage, especially after the budget announcements. There probably is some revival of certain projects that could revive some of the interest again. So I think property and construction is kind of a laggard index, and they are slowly getting back the interest of the investors. So if you track FKLI price performance in general, and you compare between Maybank, Public Bank, and CMB, the three major banks in Malaysia, which has a lot of weightage on the overall KLCI index, you can clearly see that, you know, among the three banks, Maybank and Public Bank has a lot of weighting on how the FKLI price is going to perform. You can clearly see in general they are positively correlated, which means that if Maybank share price is going to rise, you're probably going to see FKLI price is going to go up. Same goes for Public Bank. If you see Public Bank's stock prices are going to go higher, you're probably going to see FKLI index going to go higher. Same goes for CMB as well. But what I want to draw attention here is that if you just look at the price performance itself and how close price of the individual stocks in relation to the price index performance, you can clearly see Maybank and Public Bank stands out. So if you are trading the market, it's also useful for you to watch out what are the individual stocks price performance are. Are they on showing weaknesses or are they showing strength? So that will probably helps you to paint a likelihood picture of where the index price is going to go. So clearly you can clearly see Maybank is trying. You can clearly see if you compare Maybank FKLI price, you can clearly see both the lines are very close to each other. So that's indicating a very close relationship between both factors of comparison. Now, besides financial sectors, if you just look at growth, which is a hot theme in recent times, given the pandemic crisis, both Top Glove and Harta Lega are part of the constituents of KLCI index. You can clearly see, even though both have rallied, the KLCI index has not rallied that much. It has a positive linkage between both factors, which means that if you see strength in Top Glove, probably you should see strength in FKLI. But if you just look at in terms of their the strength of their relationship, is unlikely. It's not that strong comparing with financial sector. Given for the fact that if you just look at weightage alone, Top Glove and Harta is only constitute about 10%. But the three banks which I just highlighted earlier, that probably constitute about 27 to 28% of the total weightage. So banks will have always have a heavier weightage on the index price performance. Now, besides individual stocks having an impact on FKLI prices, Ringgit relationship is always another factor which does have an impact. So if you just look at the recent Ringgit relationship between the US dollar, we have seen a strengthening of the Ringgit given the weakening of the US dollar. And obviously, when you have a stronger Ringgit, it always bodes well for your financial market. When you have a weaker Ringgit, which means there's outflow going into the market, it's going to be bad for the market. So in general, I think we can create a relationship here, or we can base on historical data, is that whenever you see a stronger Ringgit, you should expect a stronger KLCI performance and vice versa. So if you are trading on the FKLI market, take a view on the Ringgit, have a look at the Ringgit to US dollar relationship, because that could have a play on how the international movements, the inflows and outflows into the financial market, that could in a way affect your FKLI performance. Crude oil obviously is another factor to watch out, given that Malaysia is a net export crude oil country. And obviously this year is also another chaotic year for commodities in general, especially for the crude oil market. For the first time, we're seeing negative number in terms of prices, which is possible if you are trading on a spot market. But then again, I think sentiment has been bearish early part of this year given the lockdowns, but then gradually the sentiment recovered. So obviously, once the sentiment of crude oil recovered, it should spill a positive effect on the KLCI market as well. So crude oil in general is again a positive relationship between crude oil and KLCI. And that always obviously linked to Malaysia being a net export country for crude oil. Now, political risks and government policies are something that is very temporal. It's not on a cyclical manner. which means that it comes and the effect is there, and later on the effect will fade away. So we have a political risk. I think early part of last month, there's talks in town where there's a potential emergency declaration. I think market on that day factor in that negative news and actually went down by 20 to 25 points. So I think market as a whole, if you are trading a market as a whole, we just have to account to such volatility in terms of political risk as well as government measures. No, we cannot accurately predict when or how, but we just have to take note when you are trading the market. And obviously, budget 2021 was just recently announced, and market take it as a good stride, so we can clearly see a general positive effect on the performance. So I think what I'm trying to reach here is that government policies and political risks are, I would say, substantial factors that can affect index performance, but it's always very difficult for us to predict. So in a way, as a trader, you can choose to avoid. You can mitigate your loss through proper risk management. But these are the events that usually will always be something that is making you on your tiptoe every time. Now, besides political risk, besides government measures having an impact on FKLI performance, US indices, especially the Dow Jones and S&P 500, which relates to external factors that can affect FKLI performance, do have an impact. And if you just look at, in general, the US, whether it's S&P 500 or Dow Jones, pretty much has a positive performance to FKLI. Obviously, of late, we see those performance to diverge, given that US indices are pretty much on steroids. They are on a different footing. But FKLI is slowly inching higher. It's trying to close up the gap. But overall, we can deduce that both the indices, the US indices and the KLCI index, do display a positive relationship tendencies, which indicate higher Dow Jones, higher S&P 500 prices. We should expect FKLI to also go higher. Now, going into seasonality, apologies on numbers due to the pixel here, but just focus your attention on the colors. So what I did here was to break down the months from January to December, from left to right. So you can clearly see, I think December is the month where you have a lot of green boxes. Green boxes here indicates month-to-month price change that's positive, and red boxes is month-to-month price change that's negative. So what I want to highlight is that December is always a period of the year where you should see prices tend to be stronger. As we head into the final month of the year, we should expect KLCI, based on historical pattern, this is based on 20 years data, should display a positive picture. Now, if just look at besides December, February, even March, or even April, October to a certain extent, are what we call strong periods of the index. So these are months or periods where if you are trading the market, you should be thinking of, because of a historical effect, because of the seasonality effect, you should be thinking on positions for you to long. And obviously, vice versa, if you just look at periods or months where you have a lot of red boxes, which is around September or May, is pretty much mixed. I would say August, September, November is very crucial. November is actually out of, I think, 20 years, that's only 6 years that is positive, the rest of it that's negative. So I think November is also can consider a weak period. So it's very crucial for you to look at seasonality, whether historical will repeat itself. But then again, this based on historical basis, anything can change the fundamental of the index itself. Like I mentioned earlier on, it could be political, it could be government measures. Now, if you are trading the futures market, it is vital to understand that you have further contract months for you to trade. So here I took a snapshot from the prices from Bursa Malaysia. So you can clearly see, if you just look at FKLI index, you have quoted November contract, December contract, March next year, and June next year. Now, what I want to bring attention is the price. You can probably compare the last time price. So this was taken, I think, 2 days back. So those numbers are not reflected as accurately. But what I want to show you is that market is actually pricing in next year's prices to be lower. So in fact, market right now is actually quite bullish. But going forward, due to uncertainty in the market participants are trying to factor in a bearish element into it. So I'm not going to go too deep on understanding why is these differences and how is this going to impact on the trading implications. But suffice to know is that understanding how market behaves or reflects a sentiment in forward months will give you a rough indication, especially on how are you going to, as you go along the time period. So if you go on to next month, you should see how the March and June contract is going to behave. So right now, I think market is trying to paint the current month to be very bullish, current sentiment to be very bullish. But as we go towards the months ahead, market is less bullish. So this is something for us to keep in mind if you're trading the futures market. Okay, so I think that's pretty much highlight some of the key factors that can affect FKLI performance. I've covered some of the key fundamental factors. So if you're trading the market, as a trader, you can choose to be a technical trader, you can choose to be a fundamental trader, or you can choose to be both. But I'm not going to say that, I'm not going to discount here is that fundamental has no relevance. Fundamental do have a relevance to a certain extent. And those factors I highlighted are some of the key factors that can affect FKLI performance. Obviously, it's not going to be an instant reaction. It's probably going to take some time to play out. And obviously, if you are doing trading on a daily basis, and definitely you need something that is very instant, and technical setups are something that a lot of traders, in fact, majority of traders uses nowadays. So I'm just going to share with you my 5 simple trading setups on how to trade the FKLI. Now, first thing in almost all markets, regardless whether it's equities market or in commodities market or in stocks space, in any of the asset classes space, it's very important for us to identify what is the market trend. Now, a market trend can be classified as a long-term market trend or a short-term market trend. Now, if you want to base on the definition alone, a long-term market trend is probably would take 5 to 25 years market trend. And that's very a long-term thing. Shorter-term trends are looking at about weeks, months, or in fact years. And those are what you classify as shorter-term trends. So now, there's 2 major distinct categories when it comes to market trends. There's definitely a bull market. Bull market is always classified as a higher high and higher lows. A bear market is always classified as a lower high and lower lows. Now, to bring that into perspective, just look at this diagram. What I highlighted here is that if you on the left is an uptrend picture of a market. So in an uptrend, you're probably going to see a higher highs and higher lows. So that's the distinct character of an uptrend market. Now, on the right is a downtrend market. Downtrend market is characterized by lower highs and lower lows. So based on pictorial, you're able to deduce whether the market is on an uptrend or a downtrend by looking at the peaks and the troughs. Are those peaks getting higher? Are those troughs getting higher? Then it's an uptrend. Okay. Now, to put into dynamics of the FKLI market, here is an actual FKLI market in print. So you can clearly see on the left side, circle highlighted in the yellow circle, this shows a lower low for a period of time, and the highs are actually also lower. So we are actually in that series, we are in a downtrend. Now, as we head over the rebound back in March, as the economy starts to recover, we are heading into a higher high situation and a higher low situation, and in that series is considered an uptrend series. Now, besides defining the trends by looking at the peaks and troughs, we can also define a market trend by using a 200 EMA moving average. EMA stands for exponential moving average. Now, 200 exponential moving average has been a common market denomination for a long-term series. That means, if you always hear on Bloomberg, this market is breaking the 200 line EMA, it's indicating a downtrend. So it's trying to tell you that the market has actually broke its long-term trend and it's going to head further down south or further up. So 200 EMA can also be used as a way to identify the overall market trend. So how do we do that? Candles below the line usually indicates a downtrend. Candles above the line usually indicates an uptrend. Now, 200 EMA line, same goes as any other moving averages line, can also act as a support and resistance level. So when you hear market commentators or when you are looking at a particular chart and you just draw a 200 EMA line, that 200 EMA line can potentially be your support and resistance level at a particular price. So when you see the 200 EMA line is not going any higher or not going any lower, in fact it's flat, that means the market in general is actually very balanced. So in that scenario, the market is actually in a tight trading range. So just to show you an example, this again is FKLI. So you can clearly see that just before COVID hit, pretty much the market was actually in the downtrend. You can see the 200 EMA line most of the candles did not breach the 200 EMA line. In fact, it was trading below the downtrend line. And if you just look at the line momentum itself, it's actually pointing downwards. So if you are trading the market, and if you see that most of the candles are below the line, we are in fact in the downtrend line. And when you are in the downtrend, now, if you are a trend trader, your main emphasis, your main motive is always to trade with the trend, not against the trend. Now, being in the market for a period of time, I think it's always, I like to emphasize is never take the opportunity to be against the trend because you are taking too much risk on your own. Always be in favor, trading in the favor of the trend. So if the trend is showing and indicates you a downtrend, think of positions for you to sell instead of thinking positions to buy. So that's a very practical approach for you to trade, especially trading the trend. Now, if we go towards the highlighted yellow circle, it's trying to indicate the flat line, the 200 EMA flat line has become flat. So that means the market is actually trading in a range. So do watch out when market trading is in a range. Whenever there's a breakout, it usually followed by a very big action, whether it's on the upside or the downside, and whenever it breaks a particular range. Now, so that's defining trend. So I would say part of the 5 trading steps, the first step is always to define your market trend. Is it an uptrend or a downtrend? And in that scenario, when you define your market trend, try to trade in relation to the trend. Never trade against the trend. Your probability of losing is going to be high. Now, second step is to define moving averages. Now, there's a lot of indicators outside. There's a lot of technical indicators outside. Now, as a trader, if you are currently trading in the market, if you have found or you're very comfortable with your current setup, just stick with it. Now, if you are trying to search, something to start off with to be a base for you to kickstart your trading journey, I think moving average is something that you can look at, and it's a great way for you to add in your technical arsenal for you to determine when is your exit and your entry points. So moving average is pretty much an indicator to indicate instrument points over a specific time period. So there's a lot of types of moving averages. There's simple moving average, that's exponential, that's weighted. But I just want to bring your attention to two moving averages types, which is simple and exponential. So now, dynamics of moving averages is basically, if you are using moving average to time your exit or time your entry, you usually look at crossovers. And we always overlap multiple moving averages. So in my case, for example, I just only use 2 moving averages or time horizon. One is a shorter time horizon, one is a longer term time horizon. Now, simple moving average is just a simple calculation. It's just adding up all your different prices and divided by the numbers of series, and that you get a sum of average, and that basically much sums up your average. Now, exponential is a bit different. And if you compare to simple moving average, exponential moving average in conclusion gives you a heavier weightage on current price. Obviously, it needs one more data more than the simple moving average because you have a multiplier effect. You have a weighting element into it. But if you compare exponential and simple, exponential gives you a heavier weightage on the current price because simple moving average gives a lot of weightage to it gives equal weightage to all time series or all price series. But exponential is a bit different. It gives weightage to the current price. So I'm not going to go too deep into calculating it. You can get all this right now. I mean, with modern technology, you can just punch in the indicator. They just calculate it for you. So obviously, if you want to understand the dynamics, you want to understand the underlying on how it works. On a deeper level, you can obviously go through the maths. But again, I want to re-emphasize, I think Exponential gives a lot of credit to your current price, and it gives less credit on the previous prices. Simple moving average does not weight on any prices, whether it's on the current price or on the previous price. So if you overlap both the simple moving average on and the exponential moving average, you can clearly see that obviously the yellow line here indicates the exponential moving average, the blue line indicates the simple moving average. So you can clearly see how close the yellow line envelopes the candlesticks. So yellow line, which is your exponential, reacts much faster to price change behavior as compared to a simple moving average, because it gives a lot of emphasis to your current price. Now, setups in moving averages are based on crossovers, and what crossovers here are always referring to time horizons in different moving averages. So there's two time horizon here. One is a 9 EMA, one is a 20 EMA. Again, this parametric 9 and 20 is based on trial and error. I'm not saying this 9 and 20 is going to be a perfect formula. In fact, in technical analysis, there's no perfect formula, or in other words, holy grail. So 9 and 20 is based on trial and error. And obviously, if you are starting new to the journey, you want to start trading using the EMAs, do back test on your own and do check out on those results. So here I'm just using the 9 and 20 days. 9 days being because it's covered 2 week span, 20 days covers a month span. So 9 days in a way is a shorter term horizon, 20 days is a longer term horizon. So if you see that the purple line, which is the 9 days EMA, is crossing above the 20 days EMA, which means the market is indicating a momentum change to the upside. And that is what we call a bullish crossovers. Now, on a reverse scenario, if your short-term lines are crossing below the 20 days EMA, that indicates that the market is changing momentum to the downside. So if you are trading on EMAs alone, you probably can use a crossovers as an indication of a possible entry and exit. Because whenever there's a crossovers, usually indicates there's a momentum change in terms of prices. So again, I think I'll highlight here, whenever you see a bearish crossover, here's a clear example of a bearish crossover. You can clearly see the shorter time frame with 9 days EMA crosses below the 20 days EMA, which is your longer term horizon, is indicate a bearish crossover. So in this scenario, you probably should time a possible entry to short. Vice versa, a bullish scenario, you can clearly see that happens when you see the shorter term MAs crossing above the longer term EMAs, and that indicates a bullish event and bullish crossover. Now, obviously, moving averages alone doesn't, incorporating other technical indicators will be helpful, but don't incorporate too much, because if you have too much indicators, it's always the problem of analysis by paralysis. So I think it's important to keep it simple. And obviously, moving averages alone may not suffice to give you an adequate picture for you to time your exit and entry. It's always good for you to incorporate other indicators. Now, what I did here is that besides defining the trend, besides moving averages, I also use candlesticks. But the candlesticks that I use is not your normal Japanese candlesticks. The candlesticks I use is called Heiken Ashi. It's also done by the Japanese. Heiken Ashi in Japanese means the average bars. It's slightly different from the normal candlesticks. And if you look at my previous charts, the charts that I use, you can notice that the candles are all very long and big, and it's green and red. There's no gaps in between. Okay, so now just to show you the difference between candlesticks and Heiken Ashi. Now Heiken Ashi, the main is it reacts. It has an open, high, low, and close. Same goes like normal Japanese candlesticks bar. The only difference is that it covers up the gap, and it takes the average of the candlesticks. There's a calculation to it. I will not go into the mathematical calculation behind, but what I want to bring attention to is that if you just look at candlesticks and Heiken Ashi, you can compare that Heiken Ashi smoothen the overall trend. It gives you a clear distinction on how the overall sentiment is. As compared to candlesticks, obviously if you are someone that follows the market, there's a lot of candlesticks pattern. You have your doji, you have your white candles, you have your flat candles. There's so many different types of candlesticks patterns that's available. But in Heiken Ashi, it's only downright to 3 simple patterns that is good enough and sufficient for you enough to determine the trend. So if you compare to your average candlesticks, Heiken Ashi gives you, or rather it defines a trend in a more prominent manner compared to your normal candlesticks, and it takes away the gap. So if you, like I said, Heiken Ashi is classified into 3 major categories. So you can clearly see the candles. If you see a big body candle, those are usually sign of change in trend. And if your wicks, your candle wicks are very short, that means it's going to be a very strong trend. Now, if you same goes like a doji pattern in candlesticks, you also have a doji pattern in Heiken Ashi. Those are basically a sign of reversal. Now, to put things in perspective, you see candles like this. You see green candles that is long and thick. That usually tells you, with the candle that is actually very small, that usually tells you that the market, the current bull market or the current rally in the market is here to stay. Obviously, when the color of the candle starts to change to red, or your candles are starting to become like doji candles where your body is very small, those are the time where you need to be very careful. Okay, so again, in the downtrend, you can see big red candle bars. So those are indicating you are in a series of a downtrend. And sideways, these are usually the period of time where, you know, if you are swing trading, you're someone of a swing trader, you should not engage because, you know, you need a certain set or specific skills set to trade, or especially during a range trading. So no, I think in Heiken Ashi, you can clearly see when you have jumbo up, you can't really determine the overall bullishness or the bearishness of the trend. That means it's a sideways market. So these 2 examples is to illustrate to you what is a sideways pattern of the market. So to put things into perspective, you can clearly see series of red candles usually highlights that the market is in the downtrend. And when you see series of green candles, it usually highlights that the market is in the uptrend. And when you see a lot of series of red and greens combined, those are the period of market where it's consolidating. And if you are someone of a trend trader or swing trader, you know, you really need to be careful when you are trading, especially on a very tight range. So I've covered 4 major steps, and the last steps is, I think, the very crucial steps is to manage your risk. I think trading is always about probability. It's managing your probability, and it's never, you know, going into the trade without putting a stop loss, because that's putting yourself in too much of a risk, and therefore it's definitely going to affect your emotions. So I think risk management as the last part is going to be very crucial and very important when you want to, as part of your trading methodology or setup. So one of the key indicators which I use to set up risk is always to look at average true range, which highlights what's your basically highlights what's your daily fluctuation of the daily high and low. So if you are trading on a very volatile market, obviously you got to set your stop loss on a greater level. And if you are trading on a market where you have a very short range, the high and low is only like a couple of points, then obviously your stop loss also has to be adjusted to accommodate the volatility of the market itself. So ATR is a very good tool for you to determine your stop loss level. And obviously, if you are someone trading in the market, you need to know your R's. R's basically refer to a risk per unit. Simple maths, you can just take your average win divided by average loss, you get your R multiple. So if you have a low R multiple, it's okay. You just have to compensate for the decrease with a higher win rate. And obviously, all this is done through backtesting your methods. Again, there's no fixed method. It's like a holy grail that can be a perfect system. The systems are bound to be tested. Market is dynamic. So average true range is a tool which you can definitely use to incorporate part of your trading arsenal for you to determine which are your level that you should be stop out and not taking too much of a risk. Okay, so just to put into perspective an example. So example, if you just look at the current candles in KLCI, it shows series of green candles in Heiken Ashi. I didn't incorporate the MAs here. So I just want to highlight that, these are potential entry for a potential entry to buy. So technically, if you just go at you planning to enter at 1585 and you look at the ATR, this is a daily ATR value, which is 28 points. That means your stop loss level will have to be placed at 1557. The reason I'm using one-time ATR is because I'm assuming you have a risk to reward ratio of 2:1, and that's usually a profitable trade if you can target a 2:1 risk to reward ratio. So to put everything into perspective and to put into trading, now this is where it's putting every steps into play. So first thing is that you always have to identify where is a trend. So you can clearly see the line that I drawn there is to indicate that the market was actually consolidating at a period of time. And when it choose to break out, and the first signal you get was your EMAs. Your EMAs are pointing to a bullish crossovers. Bullish crossovers happens when your shorter terms are crossing above your longer terms MAs. And you can clearly see Heiken Ashi is slowly starting to get green. And with that, that means the momentum is coming on the upside. So that's a potential for you to enter. So you can ride the trend as long as based on Heiken Ashi, you don't see any you don't see the Heiken Ashi turning red until the series where I highlighted in the sell signals. You can clearly see there's a multiple series of red candles in the Heiken Ashi. Now this is quite controversial. A lot of traders, for me, I'll get stop out. I'll probably take my profit and go. But if you look at it, based on this analysis, the candles are still supported by the EMA line, especially the EMA 20. That means the candles, even though you have seen a slight pullback in prices, but it's well supported by MAs. So technically, you can still continue to take that trade. But if you're happy with the amount of profit you have made, you should stick with it and take your profit. Because by taking wanting to take more substantial profit, you are subjecting yourself to more risk. So I think this trades is against very individual. It's against based on your risk profile. So, but based on the setup that I just mentioned, I think there's a very good entry for you to come out and a very good entry for you to enter. So another example, I think this was a period of consolidation. You can clearly see the rectangle box which I highlighted in dashed line. Once we came out of it, you can clearly see there's a bearish crossover in the EMAs, and you can clearly see there's a series of red candles which are highlighted by the circle dash line. So that's a potential sell signal. And again, once the EMAs are starting to show and Heiken actually starts to turn green, those are the levels where you need to take profit. So obviously, you have to look at the ATR to place your respective stop loss accordingly. So last bit, I think besides having a plan, a trading plan in focus, it's very vital for you to re-evaluate every trading decisions that you have made, even including the profits you have gained, including the losses that you have made. Therefore, I think as a trader, you need to have a trading journal. It helps you to keep tab of where are your weaknesses, where are your areas to improve. And obviously, if the areas that you have done well, continue to do it, or perhaps you can even refine it to make it better. So trading journal is definitely a must if you're trading, because it helps you to record and to gauge the effectiveness of the trading methodology. So conclusion, I think just to reiterate the 5 trading steps, first is always to define the market overall trend, whether the market is an uptrend or downtrend or a sideways market. So you can obviously use, just by looking at it, the higher highs and higher lows, or you can just use the 200 EMA line as a focus of your attention to see or to determine the overall trend. Second is to incorporate your moving averages. You can use a shorter term horizon against a longer term horizon. Here I use a 9 days and a 20 days EMA. And third, obviously, you can use candlesticks, but in my focus, in my trading methodology, I use a Heiken Ashi, which is always the average of your Japanese candlesticks. That defines a trend in a smoother way. It helps to illustrate the trend strength, and therefore I could make more timely decisions. Fourth is always good to have a stop loss. Rather, I'll rephrase, is a must for you to have a stop loss. And to determine your stop loss levels is to use your average true range, which indicates the daily fluctuation the high and low of a particular product. So if you're trading CPO or you're trading other commodities or trading other products, do take note. You can obviously, the ATRs will be very different. So you can incorporate ATR as part of your stop loss measures. Last but not least, you must have a trading journal. Without trading journal, you won't know how well you are, how good you are, or how bad you are. So I think with that, this is my contact. You can obviously reach me. I'm just going to pause here for a while, for a minute, for the Q&A. But before that, I'm just going to leave you with a quote from Rentap. I think Rentap is a very good trader. In fact, if you're keen to understand how trading works, you want to learn from the best, you can look at Rentap. He has a few good books. I think one of it is called Super Trader. So I just want to read a quote from Rentap. Most people approach trading to make a lot of money, and that is one of the primary reasons they lose. Okay, and second quote is, the realization that you are responsible for the results you get is the key to successful investing. And obviously in this context in trading, it does apply to trading as well. Winners know they are responsible for the results, losers thinks they are not. So conclusion is, you have to, if you are serious about trading as something that you want to do it in the longer term picture, you have to be treating it in a very responsible manner. And the approach to trading, if you're thinking as a way to make quick money, or and you won't lose a lot of money, that kind of mentality will not get you far. So I think I'm just going to leave the quotes with you. I'm just going to take a pause here for a minute for the Q&A, and I hand it over to Heiken.
Okay, thank you, David. So if any one of you have any questions, just leave your question into the chat box, because we still have some time to answer some of the questions. So David, we have a question here from Mr. Chong. So what is the suitable indicators and time frames to trade FKLI?
Okay, that's a very good question. So indicators here I use was moving average, the EMAs, and obviously Heiken Ashi. So I think those two are sufficient enough. Now in terms of time frame, now I'm a short-term trader. Just to disclaim here, I'm a short-term trader. I'm not a long-term trader, so I don't look at high time frames like daily or even weekly. My focus is to look at, I can go down to 15 minutes, sometimes to even an hour, sometimes 4 hours. So it goes like a pyramid. It goes from daily down to a 4-hour basis, down to an hour basis, down to a 15 minutes, or even sometimes to 5 minutes. And that's the perspective of for me being a short-term trader. Yeah.
Okay, so we have second question here from Mr. Locke. So he was asking about for trend trader, how do we manage the position for longer period, which across different contract months?
Okay, that's a very good question. Now if you are a trend trader, if you are looking into a longer term picture, longer term picture refers to months, and obviously futures contract has an expiry at the end of the month. KLCI expires at the last business day of the particular month. So obviously you have to roll over your contract if you are still sitting on the basis of a view, and if that basis of the view still holds, technically you have to roll over your contract. So I think whatever measures I mentioned earlier, the 5 steps which I highlighted, is able to apply whether you are in a short-term trader or even you're a trend trader, because I think those methods that I shared earlier does work on also on a longer term time frame and also work on the bigger trend. But obviously, if you want to overlap yourself with different contract months, that's definitely going to be rollover activity that you need to do. You can speak this to your brokers. I think they can share with you with more information.
Okay, we have another question here from Azizu. For intraday trade, what is the best time frame for setup and best time frame for entry and exit?
Okay, for intraday trader, like myself, I usually look at 15 minutes, sometimes even 5 minutes. Again, it depends on volatility. Now, KLCI itself, I think 15 minutes is sufficient. You don't see much of activity on the 5 minutes time frame. In fact, if you look at 5 minutes time frame, the methods that I just highlighted, you get a lot of mixed signals. So you tend to get a lot of I'll call it in other words lousy signals. But if you put it into a longer term time frame like 15 minutes or even to 30 minutes, which is 30 minutes is actually sufficient. And anything lower than 30 minutes is not going to be helpful. It's actually sufficient for you to justify an exit and entry based on the indicators that I just highlighted.
Okay, we have another question here from Mr. Locke regarding how can we handle the overnight gap breaks.
Okay, overnight gaps. Now, this again is a very good question. Overnight gaps as a trader, we trade it, but we completely trade it lah. The risk against you is much higher if you hold any position overnight. Now, it again depends on your profile. What kind of trader you are? Are you a short-term trader like me? I'm an intraday trader. Intraday trader means I go in the morning. Once the market opens, I start a position. I close my position at the end of the day. I will never think of holding the position overnight. So the risk of market gapping the next day will not be relevant to me. But if you are someone that is a trend trader, I tend to hold my positions a few more days. Then I would say you have to manage your risk in a more proper fashion, in a way that you have to accommodate for bigger swings. Gaps are, if you ask me honestly, it's very difficult to manage because like I just mentioned earlier in my slides, KLCI is bound to be affected by external markets like Dow Jones. Who knows what happens in Dow Jones? Suddenly can plunge 1,000 points due to a negative news, and the next day KLCI will just gap down. So it really goes down to your profile of trader you are. If you're someone that is a longer term trader, you're a trend trader, you just have to manage your risk gaps, which you just have to prepare to put a bigger stop loss level. Other than that, I don't see there's any way for you to get rid of that risk.
We have another question here from Azizu. How can we avoid fake breakout? Is there any indicator to help to detect this?
Oh, I wish I know. I wish I know of any indicators that can help detect fake breakout. Now, indicators are indicators. They are tools for you to use. Obviously, they are not perfect because, like I say, even today, what I've just shared with you, the 5 simple steps for you to kickstart your trading journey, that may have flaws, and it is very important for you to back test it, go back and try it out. Maybe do a paper trading and whatnot. Now, indicators itself is just tool, is not perfect. They're bound to have fake breakouts, but important key aspect in that is how you manage your risk. So if suddenly your indicators are pointing you a fake breakout, what you should do? You should quickly cut your loss and try the next step, because like I say, trading is a game of probability. So the more trials and attempts you do, the higher rate in your favor is going to be. So I think there's no other indicators that I can think of that can really detect a fake breakout. In fact, most of the indicators in technical analysis do have this problem of fake breakout, and they just succumb to it.
All right, we have question here from Peter asking about is KL market is going to correction?
Okay, KLCI market heading for correction. We see a strong rally from 1550 to 1600. In fact, 1600 technically is a psychological level. It broke that. So again, the question is, you look at technical perspective, can it sustain at this level? If it can sustain, then likely the market is going to hit low. It's going to hit higher. Now, this rally that we're seeing in the past couple of weeks is bound to have a correction. It's a matter of timing. I really don't know when. But based on the indicators, the trend is still up. So I don't be hoping to time a correction because, again, like I mentioned, you are in an uptrend. So in an uptrend, what you should do, you should be looking at entries for you to buy, not sell, because timing a market reversal is very, very difficult. It's as good. You need to be very precise. If not, you're going to lose a lot of money.
All right. We still have few more minutes left. If any one of you still have questions, can just leave your comment into the question box.
Okay, sorry, Hui-Chen, I just want to address this question from Mike Chiu. I think this question
Sure.
is interesting. He's asking, as FKLI is a monthly rollover and each month rollover can happen on any day of the week, not necessarily Friday. So how do we compile weekly FKLI, especially during last week of the month? If for monthly TA, do we use first day of the week or first of the month to end day of the month? Thank you for advice. Okay, the reason I choose to address this question because I think this is very technical. It relates to the function of a rollover. So for those audience who are new to futures market, rollover stands for if you are holding a futures market, a contract, and it's bound to expire before the expiry of the day, you can choose to roll over to next month. So technically, if you are buying November, you want to roll over to December, you should sell in November and buy December. So you can do that via a spread contract on the FKLI market, or you can manually close the contract and reopen in December. Now, this question is interesting because rollovers can, as what the audience accurately pointed out, it can happen any day. Now, what I want to what I want to emphasize in this question is rollover. If you look at it, it does have an impact. If you're trading on markets like FKLI, it does have impact on prices. And I don't want to complicate things, but in short, rollover, although it can happen in any day of the week, it usually happen on the last week and usually happen on the couple of days before the expiry. So I think this, I mean, if the audience, this particular gentleman wants to know more, can obviously feel free to reach me because I think this is a very interesting question, but I think it does involve complicated analysis.
Okay. Thanks, David, for the explanation. We have one question here from Mr. Lim. He wants to know what other technical indicator would you recommend that is crucial for intraday trading?
Okay. What other indicators? Obviously, your plan, your objective is to keep your trading decision simple because if you're an intraday trader, you are watching the market. I believe you're watching the market every moment. Now, things can happen very fast. Obviously, what I mentioned just now could be part of the play. If you want further things, if you're an intraday trader, obviously market profile is one of the things that you can look at, and it does help. And even candlestick patterns, if you incorporate market profile and candlestick patterns, is going to be a very good combination if you are looking beyond moving averages or even Heiken Ashi. So I would say, if you're an intraday trader, you can take a look at market profile, incorporate that with candlesticks. I think that's also another good trading methodology.
All right. We have another question here asking about if you can recommend a trade setup based on the seasonality of FKLI.
Okay. Seasonality on FKLI, a trade setup. Now, if you look at seasonality, let me just allow me to just go back to my slides. If you just look at seasonality of FKLI, will I be looking at any trade setup? So again, what I want to disclaim here is that seasonality is based on historical prices, it's historical data, it's past events. So this is based on the 20 years past data. So if you believe in the notion that historical will repeat itself, so December is the period where you should see stronger prices. Means month to month, the overall month of December should be positive. Because if you just look at 20 years itself, only 4 years out of the 20 years it was negative, the rest of it is positive. So if you are going to trade in the month of December, the market is going to have strength. So any pullback in prices, you should be thinking position to buy. So that's how I will look at it. But keep in mind, seasonality is based on historical. We are making a very big assumption that historical will repeat itself. We haven't factored in it could be major risks like political risks, especially now with the presidential in transition. We have President-elect Joe Biden that's coming in inauguration next year. So right now, the current president Donald Trump can do anything. So December, even though it's a strong month, you have to factor in all this. But just judging from the historical pattern, I think December is a strong month. I should be any pullback, I should be looking positions to buy instead of selling.
I see there is no further questions in the question box. Anything that you wish to add in, David, before the end of the session?
Okay, I hope the session today has been helpful and beneficial for the audience today. If you're someone new to trading futures, hopefully the steps I just highlighted can help you and help you to kickstart your trading journey. Obviously, trading is if you want to be successful in trading, it's never easy. I just want to be honest here. Even I myself, when I started the journey of when I put my first step into the trading journey, I was finding it very difficult. And I think the main key thing is that despite the fundamentals that you should be careful of, despite the technical methodology that you have, the one key restraint in most of the trading journey for every traders will have to face this is the restraint of your psychology, which I didn't cover in today's session because today's session is mainly on covering fundamentals and technical. But I just want to emphasize is that to become a successful trader, I think the control of psychology is much more vital as to compare to the domain of knowledge, whether it's fundamental or technical, because psychology plays a very big role when you are trading the markets. So I'll just end it with that.
Okay. Thank you for David. So if any one of you have any questions, to contact us and we are happy to assist you. So with that, I will end the session today. Thank you everyone for spending your time with us, and also many thanks to our speaker David for his insightful sharing today. Good night everyone, and see you in our next webinar.
Okay, thank you and take care.